Hey everybody, Preston Brent here with our weekly roundup brought to you by our trader user group. This is for the trading week ending, April 13th, Friday, 2018. What a very interesting week. And then, of course, we cap it off with the missile attack Friday evening going into this Saturday morning. And as I do our update for the week this Saturday morning, I'm watching the folks speak at the emergency council session in the UN. So let's see how that pans itself out. But let's take a look first at where we are right now in the markets. This week was a very pogo stick week, I guess. Markets were whipsawed during the week. The Dow, though, finished up about almost 1.8%. The S&P was up almost 2%. NASDAQ was up about almost 2.8%. It's about 2.8%, I guess. Treasury yields are still kind of holding up there around 2.8%. The VIX, we saw what I saw interesting, even though the markets were, we finished down on Friday. The Dow was down over 120 points or so. The VIX actually fell for the day, a little bit over 19%. So volatility came in on Friday. The VIX for the week averaged about 19.68%. Now, last week, I've been telling our members for the past 4 to 6 weeks now, it's about the 3 T's in the markets. That would be tariffs, technology, and tightening, interest rate tightening, but I call it tightening. But I think I'm going to move it to 5 T's. We seem to be growing T's. The 5 T's. So besides tariffs, tech, and tightening, there are what I call the Trump tweets. And those are the wild card. Those are the wild cards for the market. It's really amazing. And I think that's what's got the markets a little bit unsettled is, we can literally see the Dow move up or down 100 points, not from day to day, but how about within an hour on the day? It's really amazing what we're seeing. So we've got that pogo effect. And it seems like every day this past week, the market started up or down 40 basis points for the day, 0.4% move, even before the markets really even got going from an overnight session. Now, in overnight session, starting this Sunday evening when Globex kicks off the futures, hopefully we'll have a couple of days of calmness and rationality in the markets from this missile strike. If the missile strike had occurred during the trading week, markets would have probably overreacted as it always does. But the fact that it occurred Friday evening into early Saturday morning, Syria time, then hopefully the markets have a chance to settle down. And because there was no counteraction by Syrians or Russians or Iranians, that I think will have a chance to calm the markets, and we'll get right back into where we kicked off last Friday, which was earnings. And speaking of earnings, bank stocks kicked off. We had JP Morgan, Citi, and Wells Fargo. They kicked off, and they actually beat both top and bottom line numbers, but the financial sector as a whole, and those three clearly sold off on the day. So that could be a little bit ominous in what market expectation is. Now, as I've been saying and telling our members in our group for the past 4 weeks, earnings are expected to come in. S&P earnings are expected to come in on average around 17%, technology about 22%, and the forward PE ratio of the market is at about 16.5. Remember, the long-term average is a little over 15. So we're fairly valued given where earnings are expected to come in. Okay. Now, maybe just a little bit cheaper relative to projected corporate earnings because this year, top-line sales growth is looking to come in at over 7.2%. Last year is 5.4. So we're expecting strong. In fact, 2018 is going to be one of the strongest corporate earnings years going all the way back to 2010. So the big issue that big money's looking at is, will strong corporate earnings overcome these headwinds that come up from tariff talk and tightening and the Trump tweets and the T's that I talked about earlier? It's going to be really interesting to see what's going to overcome what. Now, I've been saying for about a year now that we're going to have a hellacious bear market, and it's setting itself up, guys. I don't mean near term, but of course I said about a year to year and a half. I said that about a year ago, but I didn't anticipate the Trump taxes and the repatriation and all those other things. So they can goose our secular bull market for another year. But I do believe we're going to see a 35 to 45% drop in the equities. Now I'm moving it out just a little bit, maybe 2019 or so, just because, the secular bull market can extend with all the stimulus that's going out there. But I mean, if you look at some of the downside that I see on the horizon, primarily with our deficit, the CBO, the budget office, came out and forecasted a trillion plus deficit for 2020. But they're saying in the next decade, our deficit is going to be 100% of our GDP. That's not good, folks. That is not good at all. And unless these goddamn politicians don't calm their spending ways, the markets are going to force it on us. The market's going to force the U.S. to get back in the line again, and then it's going to be even more painful. But maybe that's what it's going to take. But there's going to be great opportunities for us as traders. I mean, and some of my members have said, well, what about Japan's current debt? I mean, their debt to GDP is at about 250%. So does debt really matter if you can print your own money? And I say, yes, it does. If you look at Japan, the biggest difference in Japan, they have 0% interest rates, and they've had that for about a decade now. They've had a stagflation kind of market. They're trying to get their inflation back in. But the other thing is they're the biggest savers in the world. Their population. I lived in Japan for over a year and a half, and their population they save money. And the other big thing is they're a net international creditor, not borrower. They lend money to other countries. They don't borrow money from other countries. The U.S. is a huge net borrower. We got, Japan owns, almost $1 trillion of our debt. China owns over about $1 trillion of our debt. So that's going to come there. Everything is going to belly up to the bar and come to some kind of final conclusion here over the next decade. And it's going to be painful for the U.S. unless the politicians get their act together. Now, the Feds can do what Feds do in an inflationary market by raising interest rates. And there's a big worry that is going to push the U.S. over into a recession. I mean, already the 2-year yield curve is moving towards that flatline number. All right. So there's just a lot of events on the horizon here. And I say, I extended my bearish call for at least another year to a year and a half because of all the stimulus that's being pumped in. And unless there's big changes, folks, it's going to be a real interesting play. Now, for us in our user group, we're going to have some fun. Some of the best money we made was in the 08 and 09, 2010 debacle with the U.S. market. So we're going to profit when others are just feeling major league pain. But that's kind of what I'm looking at right now in the market. So why don't we now take a look at the the charts here? What I've got on the screen is the E-mini S&P 500 futures. Okay, and as you can see clearly here, right? I mean, let's just look at this for a second. You can see here, I've got this trend line moving up like this. And I've got this like this. So on a short-term basis, on a 2-hour chart, generally that would suggest in an ascending triangle a breakout to the upside. That's kind of how the price action has been setting itself up going into earnings because they're going to be so strong. And we saw the initial indication of that, but I will also point out to all of you that trading volume this week was the lowest we've had in a long time. In fact, on Friday, the trading volume was the lowest all year. So we've got low trading volume. It may show some indifference in investors. The favorable break is to the upside. This red line coming down is the 50 EMAs. So and you can see this 200 line here is just basically running slightly flat. So we've got these two converging at that level like this. So we are sandwiched between the 50 and the 200. We only went below the 200 EMA for just one day because the very next day we bounced right back up it again. Intraday, we've come all the way down. And you can see back here in February, we closed for the day way up here, but intraday we came all the way down here. So there are a lot of buyers sitting in this, what I would call a wider S1 level. It's a support level right here on a daily chart. And you can see the volume over price is at its peak right here. And if I extend that out, that's exactly where we're sitting right here. So we're at an area where the market feels comfortable, although as a trader, you may feel uncomfortable just because of the choppiness of the market. And the next area where volume really extends itself is right up in this area here, where I also have a natural pivot point at 2730. Okay. Now, that is kind of what I'm looking at here on the chart. So we've got this very wide range here. And I'm spending a lot of time on the S&P because if the markets roll over, I don't care what stock you're holding unless it's an inverse, generally you're going to suffer as well. All right. So if we look at this wider view here, you can see in February, we came down 12.14% from the peak to the trough down in this area here. And now we're just trying to make way to get back up here again. Okay. Now, you can see right at that area there, we were shoved back. We could not get up and make new pivot point highs. That was an ominous sign that really just said, we're still not done with this sell-off. And we came down and we actually, if you look at where we closed over here in February, we actually took out those lows, those closing lows. All right, so that's significant. We took out these closing lows and now we're working back up this triangle right here, this ascending triangle, like I said, with a potential break to the upside if earnings come in strong. Now you throw in some of the other T's that I talked about, like the Trump tweets, tariff talk, and then of course the unknown, which is kind of the known unknown, which was the missile attack, but fortunately it was limited. There's no repercussions thus far this Saturday morning as I do this weekly update. So I'm hopeful that it's going to make markets a little bit jittery though. Okay, so there's not going to be a lot of conviction in the markets. Now, if equities start to climb and we get strong earnings, like that's what all analysts are swearing to their mothers on, then we'll see a breakout to the upside according to this pattern. We should take out the 200 EMA and then we'll work our way back up to challenge this area right here. If we fail and we start coming back down, I'm going to shift more bearish. Okay, so that's assuming earnings come in where everybody's expecting them to come in. Okay, so that is kind of where we're sitting right here. If I take this out to a 2-hour chart, let's come into a swing trade time frame, roughly 2 hours. You can see the movement here. All right, so this is the pattern over a 2-hour period. You can see the fib nodes that I've got on here, as well as the 2018 open price. You can see both times we've been rejected at the 2018 open price. Prices are not ready to go back into the green for the year. You can see we were rejected there. We were rejected there. We couldn't get through there. You can see even on this 2-hour chart, volume over price, there's where it's all sitting. And if I were just to extend that, right in that area there. So you could consider that the value zone, the MACD, is basically kind of coming in like this as well. So we're boiling up for, and if I were to extend this line over, like I said before, that gives us our ascending triangle on a 2-hour chart. So we're going to boom, and then the odds favor a break there, but we could break here. And then come down and test some of these interim lows here on this 2-hour chart, right? So that's kind of what I'm looking at. I want to see which way we break. Sunday night is going to be an interesting open for the markets. All eyes are going to be just where are the indexes going to open up. Now, Monday, we've got a couple more banks coming out, Bank of America and M&T Bank, right? So those are going to be closely watched. But we also got Netflix earnings after market close. Okay, so we already had a trade on Netflix and we closed it down for nice profits on Friday. We have a strategy that we use for earnings plays, which really allow you to play a stock but not really go through the volatility suck that you get right after an earnings statement is released. So anyway, this is kind of what we're looking at. Surprisingly, the Russell is performing a little bit better. Look at the Russell here. We're actually in the green for the year for the Russell. So small cap value, small cap growth, but small cap value tend to be a better play right now. That's kind of where money is going. You can see we're well over, well, not well over, but we're over the opening price. So we're in the green for the year. If we look at this on a daily basis for the Russell futures, you can see here we almost made new highs back in March, where we couldn't nearly get up there in the S&P or the Dow. In the Russell, in the Nasdaq, we actually made new highs, right? And then we backed off. You can see the 200 EMA provided firm support here in early April, and then we're back up in the green here. And if we look at Nasdaq, you'll see we did make new highs in early March. See here the new highs right here. It's the only index that did it. And then we sold off hard. That was one of the T's in the 3 T's that I was talking about. Money was rotating out of some of the tech, taking some profits. We actually went into the, as you can see here with the 2018 open price, we actually kind of hovered right around slightly in the red. The 200 EMA provided support. So like I said, it's the dueling moving averages right now. And then boom, up we go. Now we're going to have overhead resistance in the 50 EMA. So these are all the things I want to be watching for. As we dance with the devil here between the 50 and the 200 with volatility that's elevated, just, a little bit more. It's at its longer term average, but it's elevated from what we're used to over the past 2 or 3 years. And then finally, if we look at the Dow, let me get the Dow futures on here. Here we go, right here. You'll see the Dow futures, again, off the 200 EMA. Right, you can see the Dow futures off the 200 EMA. We're in the red here. Here's the 2018 open price. We're in this very wide support zone right here. So I think earnings are either going to kick us up or kick us down. Now, watching how markets responded to bank earnings was not a very good thing, because the bank earnings beat both top and bottom line. But the reason why they were punished was their forward guidance was not as strong. Remember, a lowering yield curve, a flatter yield curve, is a net negative for banks, not a net positive, even though interest rates are going up. 2-year and 5-year are going up faster than 10-year and 30-year, which has given us a lower yield curve, which generally is, you can measure the yield curve in a number of different ways, but I think the common wisdom is generally the 10-year minus the 2-year. Okay. And if you look at that and just stick with it, you'll notice that it's going down and down and down, which is not good, right? That tends to flatten the yield curve, which tends to suppress bank earnings. So I suspect the forward earnings for banks were not as good, even though they beat both top and bottom line numbers and they sold off, right? I mean, if we look at XLF, which is, they kicked off the banking sector, look at that. I mean, we were on our way to taking out some highs here, and then boom, we came back down. All right, that says 2017 highs. So we haven't really gone anywhere in almost 2 years. We're net, almost where we are. But you can see here on that chart, if I take it down to a 2-hour chart, you can see here where, boom, we come out during the day, right? We come out during the day right at earnings time. They reported, they sold up, and then in the morning rather, they sold off, and then we just went down. That's not good. Okay, selling off when you beat both top and bottom line numbers is not a good thing. Now, again, I always say it doesn't matter whether companies beat or don't beat. I mean, you'd like to see wins, right? But you want to see how price action reacts to an earnings statement. And generally, prices are not reacting to where we are now in earnings, but they generally react to where the forward guidance is. And this tells me the forward guidance is not as good, especially with a declining yield curve. Okay, so that's just something we want to pay a lot of attention to. If we look at volatility, as I said, volatility came in on Friday, 17.41. I mean, look at this. During the entire day, the Dow was moving down. It was very choppy, but it was moving down. But vol was also moving down. This is a 2-hour chart. We're in the yellow zone still. Let me take it out to a daily. You can see here, we're still in the yellow zone. I said when we had this big move up here and moved into the red, almost into a black swan event back in early February when we had a liquidation of XIV. We briefly were up in this level here over 50, and then it quickly sold off again. But I say when these things happen, volatility is very sensitive to any downside movement. It tends to react to the upside with more vigor than it does when we were down here in 2017, where vol was down around 8 or 9. But now, once we're more sensitive, we're going to stay in this yellow zone, which generally runs from about 15 to about 20, 21 in the VIX, right? Now, these are my zones. I put them on the chart just so it changes the nature of the types of strategies that we want to do in the option market. But this is kind of where we're sitting right now. And if we look at treasuries, the really interesting thing with treasuries and the currency market is volatility is very low. And you can see the treasury market here. We haven't really gone very far. Now, I'm calling for the bond market to come back down to the 141 area. Any move up in bonds, I'm more of an interested seller than a buyer in bonds. We're north of the 50 EMA, but south of the 200 EMA. And you can see where the 200 EMA was taken out by the 50 EMA back in December of 2017. So starting off this year, being short bonds has been a good play. Now, we played bonds to the downside. Even with that big fall in the markets in February, right? I mean, if we look at the big fall in the markets in February, what did the bonds do? They kept falling. So that was, as I told our members, Q1 was one of those interesting quarters where both equities and bonds fell. So bonds may no longer be that safe haven should the markets, just get totally creamed, and money tries to seek the safety of the bond market. It's not going to be like it was over the prior years where if the markets fall, bonds go up. Now, we've had this interesting move higher here off these lows. In early March, we've seen the bond market move up, but I think the bigger risk is to the downside in bonds. Okay, that's kind of how I see that right now. Now TLT, which moves in the same direction as the bond market, the volatility is relatively low. So if you want to hedge downside moves, TLT could move up, so you could do some out of the money calls there. That would make some sense to me as just a hedge because vol is lower than normal for TLT. I think longer term though, TLT is going to move down. And if I had to do a short term projection, I had forecast TLT to come down to 109. But if I modify it, that's a weekly. If I look at it shorter term, 113. Now we're sitting at 120. So, and this is a combination of Gann and Fibonacci extensions to the downside. I could have just as easily drawn them, but this just reduces some of the clutter on my screen. But and it also measures a 3-4-5 Elliott wave pattern, which would suggest we've got a three leg down, 4-leg counter trend up, and a 5-leg sometime over here in the summer months. So this would suggest the Feds are still going to keep hiking rates, and that would push TLT down. Of course, TBT goes in the direction of interest rates, so playing TBT to the upside. And as you can see, we've got just the opposite, a 3-4-5 pattern going just in the opposite direction. So I could click on that, and that would suggest that TBT can move up to the 42 area, and it's sitting at 36 right now. So things are lining up here to suggest higher interest rates. Longer term play in the TBT should be to the upside. Now, if the markets roll over and equities crash, we could see TBT come back down again. Interest rates stay a little bit lower for longer. Because it wasn't but just, in December of last year, TBT was down around the 33 area. So, but I still think the odds favor playing TBT to the upside or TLT to the downside. Or if you want to play that war and battle in the futures market, bonds would be the place to go. Okay. That would also suggest the dollar is going to start to move higher. We've been building a consolidation pattern here in the dollar since January this year. You can see all of 2017, the dollar I could have extended this channel, but we stayed in this downward channel all of 2017. Everybody was so lopsided long in the dollar that when the markets get crowded to one side, it tends to go in the other direction. Everybody thought interest rates were going to be climbing, which they're slowly doing, which would be bullish for the dollar. But if you look at the dollar, it's done nothing but go down. And any move up, like in this counter trend move here, it broke the channel and then back down we're going. Now we're building a longer term base. I think the dollar can run a little bit higher and surprise people because everybody and their uncle and aunt are short the dollar right now, which means be ready for a little bit of a move higher in the US dollar. All right, just a counter trend kind of move. And by the same token, the euro, which I think is in the next 50 years is a failed experiment. It's been chopping around in this range. I suspect the euro, if it breaks this range to the downside, you're going to see the euro fall down. Okay, so that's kind of where I'm looking at here on this one. And then of course, if we look at some of my favorites, if we look at gold, well, gold is, if you look at this chart on gold here, and let me just see if I can do this like that. There is gold. We've been in this wider chop here. You can see the 2018 open price. And if you look up above, I've got the 2017 high, or 2016, 2017, 2018 highs. We got a ton of resistance up here, folks. I'm maybe 2 years out. I'm very bullish gold. Now it's just we've got to break out of this area here before I get very bullish. I'm not that right now. I'm more into the chop. And it's if you want to do day trading in gold or GLD, that's okay. But any longer term macro trends here, I think gold will be bullish, but I want to see a little bit more of a breakout here before I do that. Same thing with silver. Both gold and silver were up a little bit, but look at silver on this daily chart here. Let's move it out to a weekly just so that you guys can get some perspective on this. And you can see on this weekly chart, we've been in this consolidating triangle here since what, about July, summer months of 2016, and we're just winding up. And I think we're going to break that and we're going to move higher. Now, typically in a symmetrical triangle, the break is to the direction that you entered the symmetrical triangle in, which means because we were moving down and then we entered this, the odds, the technical patterns suggest a break to the downside. Okay. But my view is there's just too much leaning in the way of a major bear market hitting in the next year and a half or so. And that would suggest a break from this and then just a capitulation in the markets. And then we're going to see silver up north of 21, 22, right? At least. Keep in mind from a notional value standpoint, SLV, it's relatively cheap, but it takes 5,000 shares of SLV to equal generally one silver futures contract because it's $5,000 a point in silver futures versus 5,000 shares doing 5,000 a point in SLV. So there's going to be a number of ways to play this. Macro view, I'm bullish silver. All right. You can see this long volume over price. So we're just right here. We're building up. We're building up a long consolidation pattern. And then I think, bam, it's going to run. So it's for our members, we're going to have a lot of fun with that one. And possibly as a sideline trade gold, but I like silver as the play. And if we look at oil, well, oil made new 2018 highs, right? Let's go back to a daily chart here. You can see here how well, first of all, in this trade, you can see how we took out the highs in 2015, right? That was back in the 62 area, and we've already taken them out. So we haven't been this high going all the way back to 2014. So we're working our way back, all right? I think we're going to run into some resistance up here, but just so that you know, we've made some new highs in oil. We made a new 2018 high of 67.76, but notice it's an Elliott wave 5. And it does suggest with some of these divergences here that this up move here, now we've got, with the turmoil this weekend, there is probably a $2 or $3 barrel risk premium in oil. So if things settle down, we could see some of that come out of the market and a little bit of a settling in on price. All right. I think oil can move up a little bit higher though. So I'm still, from an oil standpoint, more bullish than neutral or clearly bearish. So that's kind of what I'm looking at oil. I think near term it's going to be choppy. We've got that risk premium already built in. If things settle down in the Middle East, there's still going to be a risk premium in it. If the fighting extends to Iran and Russia, then you're going to see another $3 or $4 a barrel immediately get tacked onto the price of oil. Okay. So that's kind of, and you can see here longer term, I was calling for oil moving up around $71 a barrel. All right, so another $3 a barrel, taking us out into the summer months. So that's kind of what I'm looking at for oil and in the energy market. We're also doing some things. We just put on some trades in the ag market. And for those of you that are non-members, I highly encourage you to come in and check us out. We've got a growing international user group as well as folks in the North American markets coming in. So come on and check us out. For our members, I will see you guys this Sunday night for our weekly market watch. For everybody else, you can get our updates next weekend. Also, we're running our Option Masters education series. We've been running that for a while, but it's going to run for several more months. We got a lot of great things going on there. We get new members every week. So I would highly encourage you to come in and check out our Option Master series also. All right, everybody, have a great weekend, and let's stay tuned for the Sunday night opening in Globex for the futures. Let's see how we're going to kick off this week. Keep in mind that for the next 3 weeks, we get about 75% of all S&P 500 companies releasing their earnings. So earnings are going to slowly take center stage if there's no response other than just diplomatic from Russia and Iran, things will slow down and then earnings will be back front and center. Have a great weekend, everybody. I'll see you guys later. Ciao.